to do our portfolio report and market analysis. And after that, I will give our investment lecture for today, which will be about real estate investment trusts or REITs and a case study of classic portfolios. And if we have time, we will do an open discussion. Okay, so I'm so excited to announce that we have a new Vice President of Media Design, Emily Chun. Emily is a freshman at the Hockaday School and will serve as the VP of Media Design. She oversees the editing and creation of images, videos, flyers, posters, and other promotional materials for our organization's activities. She is passionate about business and investment and is a part of the DECA and investment clubs in her school and Youth Entrepreneur Society outside of her school. She has played piano for 8 years and is also on the debate and varsity track teams. So let's give a round of applause to welcome Emily Chun. Okay, so the second announcement I want to make today is that we now have two new VP positions that are available, the VP of Fundraising and the VP of Charity. So for more details, you can go to our website to the blog page and we will have a post there about that. So we have also, I would also like to talk about two of the organizations we have donated to. We have donated to, of course, many more, but this Citizens of Tomorrow is one of the organizations we have donated to. The church in Plano is also one of them. Okay, so the return in March of the Hoperation Fund portfolio was negative 3.5%. However, if you have looked at the stock market recently, you know that this has been absolutely terrible. SPY has had a loss of negative 5.86% in March, and QQQ has had a loss of negative 7.72%. So the year-to-date of the Hoperation Fund is now around negative 2.8%. Meanwhile, the year-to-date since the beginning of this year for SPY has been negative 4.55%, and QQQ has had a loss of negative 8.28%. So, because of these recent market changes and conditions, I have made some portfolio adjustments. I initially sold NVO and purchased SYF with 3% of capital. I also purchased SQQQ with 15% capital for hedging. However, recently I sold SYF again, not because its fundamentals changed or not because it was a bad company. It's actually a great company, but because I needed to raise more capital for more hedging. So this pie chart shows it shows the industry breakdowns of the whole Hoperation Fund portfolio and what industries we have in our portfolio. You can see we have a wide variety of industries, from interactive media and services to insurance to broadline retail, pharmaceuticals, semiconductors, consumer staples, etc. So we have a pretty nice even distribution. Mm. So the so here's also a screenshot of our portfolio statistics. And you can compare this to the S&P 500 statistics too. So the debt to equity ratio of the S&P 500 is 1.5. The debt to equity ratio of our portfolio is 0.1. The ROE and ROIC of the S&P 500 is 19.1% and 9.8%. And while the return on equity and ROIC of the Hoperation fund portfolio is 29.6% and 36%. The gross margin of the S&P 500 is 32.5%, and the gross profit margin of the Hoperation fund is 56.7%. The free cash flow yield of the S&P 500 is 2.5%, and the free cash flow yield of the Hoperation fund portfolio is 5.5%. And you can also see that the revenue or the 3-year CAGR is for the Hoperation fund portfolio is 18.1%. So much larger than the S&P 500's CAGR. So the total return of the Hoperation fund since its inception is now 69.7%. In comparison, the total return of SPY in that period of time was 37.1%, and the return of QQQ was 36.7%. Okay, so I'm sure most of you guys should know now the market direction is now bearish. Based on the long-term investment model of the Hoperation fund, we have determined that the midterm and long-term market direction is now bearish. The CNN Fear and Greed Index is 4, which is at the extreme fear category. This is a very low number. I don't think it's been that low since like the pandemic, but I think this is a little bit of an overreaction, and I believe while the overall market direction and market trend is very bearish, I believe we will probably have a bounce back in the stock market, or at least a minor one, in the near future. However, I think the big market direction is still bearish. So right now, I would suggest having a minimal position in stocks, about 0 to 20%, and 30 to 80% in cash or cash equivalents or like short-term treasury bonds, 20 to 40% in long-term bonds, and 10 to 20% in gold. The market valuation right now is slightly overvalued. I said before that if you take the reciprocal of the 10-year treasury yield, you get a good value of the S&P 500 PE. So if you take the reciprocal of 4%, you find it's around 20, it is 25. So you may think that the S&P 500 right now is at a fair or reasonable price. But this method of like valuing the market only works in a period of like stability of like stock market stability and economic stability. So however, right now the stock market is really unstable and there's a lot of uncertainty. So that you can't really use that method to value the market as it's really unstable right now. So I would say that the stock market is still slightly overvalued. Mm. Okay. And from like various stock market articles and from Wall Street, you can also see that the market is in a state of panic. Um, you can, for example, you see the screenshot of this article, and you can see the headline. So one point I want to mention though is that right now JP Morgan's head of economic research raised the probability of a global recession to 60% from 40%. So it was originally 40% and now is 60%. So the bank expects US gross domestic product to contract 0.3%, blah blah blah. So what this means is that the market and the economy is now very negative looking. Okay, so I see we have some questions here. Minia Shun asked me what is going on with negative returns right now. Is it Trump issues? Yeah, that's one of the reasons. Trump's new tariffs and other countries like tariffs to us, that has raised like a big panic in the stock market. People have sold a lot of like their shares. And additionally, I've mentioned before in previous meetings, in a lot of previous meetings, the stock market has always been looking very bearish, and now it's like officially like in a bear market. But yeah, many people are like panicking from like Trump's new tariff policies. Oh yeah, and Sebastian said that the S&P 500 is down another 5%. Yeah. Wait, the many people are now in like a state of crisis. So Chloe asked, how long do you think the bear market will last? I believe the overall trend is bearish, and while we may have a little bit of bounce backs here and then, tech generally stock markets and like the big trends, they take a pretty long time. I'm not like a predictor or anything, so I don't know how long the bear market will last, but I think it will be a considerable amount of time, maybe a few months. But that's my opinion, so you shouldn't take it like word for word. Okay, so does anyone want to guess what stage in the stock market and in the economy we're in right now? Okay, anyone? Okay, so from the recent news and anything, you can see the stock market, we are now entering the bear market. Okay, so now I have a question for you guys. Based on the current section of the market and the economy we're in, what sectors do you think will perform the best? And this is an open question. So, does anyone want to share? Mm, If you have any opinions or anything, you can put it in the chat. Okay, but okay, so I just opened it up, never mind. So the sectors that have had the highest or biggest performance in March have been the energy sector, the utility sector, consumer staples, materials, etc. Mm, mm, okay, so now um that's the end of the market analysis for today. I have also a call for involvement that I want to make. So now I am seeking several members to share latest financial news in each meeting. He or she has a few minutes to present, and they and slides are optional. If you do make slides, then could you please share it to me? But if you participate, you only need to like talk about the recent financial news or something you think is really interesting, and it will be mm, just a quick tiny talk. So does anyone want to do this? Okay, Rob. Okay, that's great. Sebastian. Okay, that's great then. Then
Wait, do we have to do it like right now?
oh no, it's for next meeting.
Oh, okay.
So I will write this down then. You guys can prepare like 1 to 2 minutes to talk about um, the stock market. Okay, that's great then. So we right now we have Rob and Sebastian. Does anyone else want to share? Okay, William said he will do it as well. Great. Oh, it will be so exciting to have so many people um talk about their own opinions and news. Okay, so now let's continue to our investment lecture for today. Today, I will be talking about REITs, or real estate investment trusts, and REIT ETFs. I will also do a case study on classic portfolios, namely Warren Buffett's 90-10 portfolio, the 60-40 portfolio, and the permanent portfolio. So let's get started. So what are REITs? REITs, or real estate investment trusts, are investment companies that use the money you invest with them to build or buy real estate assets. These assets may appreciate in value, meaning they may generate capital gains, or they may generate a regular income from which you can get a return in the form of dividends. REITs can be bought and sold like a stock, and they allow individuals to invest in large-scale real estate assets without directly owning properties. So I think this picture below summarizes it pretty well. Basically, you or an investor invests in shares of a company or a REIT. That company then makes an acquisition or an investment into a piece of real estate. From that real estate, they generate money, sometimes like rental income, or if they sell it, um, they generate profits, and and from those profits, they give you no less than 80% of the profits they make, and they give it to you in the form of dividends. So this is a great way to invest in real estate without you actually having to go to the trouble of buying a house and then like renovating it and then selling it or renting it or anything. So it's really convenient. Oh, so Mina asked, what is the difference between this and an ETF? The difference between this and an ETF is that for rates, like the companies are basically helping you invest in real estate, and it's not like for an ETF, it's like a company that sells a product or a service or something. For rates, like they're basically earning money from real estate, and um for like some ETFs, they don't like just give like profits to you like as like dividends, but for rates, they just give it rate. And this profit includes negatives, right? ETF like housing. Okay, you can kind of think it that way, except that ETFs are like a bunch of companies, and a rate is just like a single company. And there are some like other major differences, but okay, if you put it simply, slightly, but not really. Okay. So there are three main types of rates: equity, hybrid, and mortgage. But today we're just gonna focus on equity rates because it's like simpler. There are also many types of rates. Um, One common type of rate is a healthcare rate. So healthcare rates own, operate, manage, acquire, and develop healthcare-related real estate. So these facilities include senior living communities, hospitals, medical offices, patient facilities, life science, innovation and research facilities, and nursing facilities. So there are many advantages from healthcare rates. One advantage is that it benefits from the massive and growing healthcare industry. So as of course, Intuitively, as the healthcare industry is growing, then more like hospitals and medical facilities will need like offices and places to have their businesses. So then these healthcare rates will benefit from that. The baby boomer generation is also like aging and then drives demand up for senior housing. Healthcare rates are also additionally ideal investments during recessions due to stable, predictable rental income. Mm, After all, even in recessions, everyone needs like healthcare, like if they get sick. So these healthcare rates will not be uh, like majorly impacted by recessions. Some risks of healthcare rates are that they have to borrow heavily to acquire and develop real estate. So they will be like impacted by rising interest rates since they have to borrow money from banks. And if the interest rates rise, then of course their profit will decrease. Another risk is of oversupply. Like if there's too many hospitals in one area, then the business for the hospitals will decrease. And then there's tenant risks. And this doesn't happen a lot, but if there's like a big pandemic, for example, COVID, and a lot of buildings and offices have to shut down, like what happened to China during the pandemic, then that will be a risk to the healthcare rates, even though you may think there's like more business, blah blah blah. Another type of rate is a residential rate. So this might be like your more the rate you might think of first when you're thinking about rates. So these residential rates buy and hold property and then rent the property to tenants using gross leases. Residential rates can hold virtually any collection of residential rental property, from hundreds of single-family homes to apartment buildings or huge multifamily complexes. An advantage of residential rates are that they are recession-proof, since people always need places to live. So if there's like a big recession, they won't be severely impacted. The housing demand is increasing too, as like the population is increasing. So the residential rates will probably have a good, stable growth. Additionally, fewer people are now able to buy homes, so they may choose so they may have to live in apartments, and this would increase the business for some REITs who rent apartment buildings. Of course, there are also many risks to residential rates too. Um, for example, there's risks from the housing markets. And residential rates tend to have huge debt in the beginning. After all, they have to buy a large plot of land and then like build a big apartment building on it or like a residential building. And they have to have all sorts of amenities. They have to have plumbing, air conditioning, build various different facilities. So they will tend to have a lot of debt when they are first starting. Therefore, they will have to have a huge occupancy rate to break even. For example, if they an apartment building might have to have at least 70% of the apartments in that building to be occupied in order to earn enough money to like maintain the building and to break even with the debt. And there's the traditional risks too, such as oversupply, rising interest rates, etc. Then there's self-storage rates. So self-storage rates own and manage self-storage facilities that they rent to individuals and businesses. One advantage of self-storage REITs is that they benefit from steadily rising demand for storage space, as there are more and more smaller startups and companies that are beginning to mm, uh, be developed, then those smaller companies will need a lot of storage space, and self-storage REITs mainly get their profit from that. Self-storage REITs, unlike residential REITs, also have low occupancy break-even rates. Because it takes very low cost to build and maintain self-storage buildings, you just need to buy some land, build make a building, and that's pretty much it. They will have slightly less depth, and they will not need as much percentage of your rooms to be occupied in order to break even with your costs. Self-storage REITs, because of these advantages, also are one of the best performing investments in the REIT sector. So they're a nice REIT to own. Of course, there are again other risks, additional risks to self-storage REITs too. Like there are low barriers to entry, and they don't have a big competitive advantage. It doesn't cost much to just build a storage building, and there's no competitive advantage for self-storage REITs. So this may lead to some problems or risks. Um, Self-storage REITs also have more exposure to an economic downturn, since most of the profit comes from smaller companies who are renting storage space. Those smaller companies are more easily impacted by recessions or economic downturns than, say, larger companies, obviously. So self-storage REITs can be heavily impacted by recessions. And we have retail REITs. Retail REITs own, operate, manage, acquire, and develop retail-related real estate, such as shopping malls, outlet centers, shopping centers, and freestanding retail properties. Retail REITs make money by renting space in their properties like malls to retailers and service providers, etc. An advantage of retail REITs is that some segments, for example, pharmacies or home improvement centers of the retail center, will continue to grow and demand physical space. So therefore, retail REITs will have some growth from those segments. These REITs also have steady rental income. Um, for some specific tenant types, um, and some specific lease structures, um, retail REITs are have can have a steady rental income for larger periods of times for from their real estate. Retail REITs also have risks, for example, recession risks. If there is a big recession, then business might decrease the for the retailers or companies that rent the malls and real estate that the retail REITs own. So if there's a recession coming, then those companies might lose some money and potentially go bankrupt. There is also the risk of disruption by e-commerce, as more businesses are turning to online shopping to display their goods and services. They find they might not need physical space as much, and they might stop renting so much space in these malls and outlets and turn their business to e-commerce. So here are some key metrics to evaluate if you're deciding whether or not to buy a REIT. One metric is the funds from operations, or FFO. So that metric measures the cash flow and the like profits from the operations, and that directly impacts the dividends that you receive from the REITs. Another important metrics, another important metric is the net asset value. That metric estimates the REIT's total asset value. And then there's the dividend yield, which is in a percentage, and this is like the income potential for investors. And then there's the dividend growth, which is also equally important, and it's basically the growth of the dividends. And finally, there's the debt to equity ratio, which measures the amount of debt the company or the REIT has and measures its financial health. So here you can see this graph shows the occupancy rates in four major sectors of REITs: apartments, retail, industry, and office. And this graph is just interesting to look at to see the growth in the occupancy or like the decreases in occupancy of the sectors of REITs. Here is also a visualization of the real estate sector performances in each year. You can see the returns of the different sectors have been ordered from greatest to least. And this is a really interesting chart or visualization to look at because you can look at the different patterns in the sectors, and you can try to see like which sectors have appear the most at the top compared to others. After all, like you see some sectors um are in like consistently in the top five best performing sectors in each year more than others, and it's interesting to look at. So, does anyone want to share like which sectors based on this visualization you think consistently perform the best or better? So I'll give you guys a moment to look at this. Which sectors do you think performed best? You can uh, type it in the chat. Okay, Emily says housing. Oh yeah, like multifamily housing. Mina Sean said cell towers. Yeah. Um, mall, home builders and storages. Nice. These are all really interesting answers. I guess if you like took the time to look through all this data, you could like definitely find some like best sectors. But just by looking at this, I think some sectors that consistently perform in maybe like the top five or six are like apartments, storage, mm, I guess like multifamily housing. Some people said mall, yeah, um, cell towers, etc. And the interesting thing about this is that if you take like the first few best performing real estate sectors, if you could somehow like predict that every year or something, then you could actually make a lot of fat juicy profits. Like if you in 2010, if you picked the best performing real estate sector, apartments, and invested in that, you would have had 47% returns, or like storage in 2011, home builders in 2012, um, You can see these are all high, big, juicy, double-digit profits. But it's really hard to like predict those, of course, because you can see each sector goes up and down a lot. Like apartments was first in 2010, then fourth in 2011, and then last in 2012. And then you can see mall in 2021 had a return of 93%, but in 2020 had a loss of negative 37%. So like while the general rate index has like in this yellow box has had like pretty low returns like in the single digits or low double digits. If you take like the first few real estate best performing real estate sectors, you find that they actually have pretty high returns. Okay. So should you buy rates? I summarized the pros and cons in this table here. Some pros of rates are that the returns are similar to those of stocks. They also have high dividend yields of around 3% or sometimes even higher. They're easier to buy or sell than physical properties. Like unlike if you wanted to invest in real estate like by yourself, then you would have had to like go through the long, tedious inconvenient processes of buying a piece of real estate and then maybe renovating it or fixing it and then selling it or renting it. That would take a lot of time, but instead you can buy rates and it's way more convenient. Rates can also be inflation hedges and offer diversification to stock portfolios. Some cons of rates are that they are pretty sensitive to interest rates and economic downturns or recessions will affect property values. Some rates, depending on the sector, also have high debt levels, which can be a big risk for the business. And their dividends are not tax efficient, meaning I think they're taxed compared to some qualified stock dividends, which sometimes are not taxed. So besides rates, there are also rate ETFs. So one rate ETF is XLRE, the Real Estate Select Sector Spider Fund. And you can see here are some important metrics. The gross expense ratio, number of holdings, yield, price over earnings or PE ratio, price over cash flow. And to the right, here is a screenshot of the top 5 sectors that it holds. So here I plotted the graphs of XLRE in blue and SPY in red. As you can see from this graph and from the data here, XLRE has a pretty significantly smaller compound annual growth rate than the S&P 500. And you can see it does underperform the S&P 500 index. So this shows that the general overall real estate market still underperforms the stock market. However, if you do take like if you take a few like good sectors and invest in them, then you will have much higher returns than the overall like real estate market. So next, let's move on to our case studies. Today, we will be covering 3 classic portfolios. The first one is Buffett's 90-10 ETF portfolio. I mentioned this in previous lectures, so I will just skim through this, and I think I gave you guys some reading material too. Basically, Warren Buffett's ETF investment strategy is to have 90% in a S&P 500 ETF or a market index ETF and a 10% and 10% in a short-term bond ETF. And here is the plot of Buffett's ETF portfolio, 90-10 ETF portfolio with the S&P 500 index ETF. From the chart or table here, you can see that the CAGR of Buffett's 90-10 ETF portfolio is slightly smaller than the CAGR of the S&P 500 index, but Buffett's 90-10 portfolio has a smaller standard deviation, meaning that it's less volatile, and it has a worst year of negative 32.66% compared to a worst year of negative 37.02% for the S&P 500. So in summary, Buffett's 90-10 portfolio, which is composed of 90% in an S&P 500 ETF and 10% in short-term bonds, generally is pretty simple and easy to follow, like intuitively. Its return potential is pretty high. It's very close to the market return, and its diversification is pretty like low or medium. It's mostly US stocks with no international exposure or other assets. Its volatility is pretty high, as the 10% short-term bonds don't offer a lot of protection in bear markets. And it's best for either young investors who have a lot of time who can tolerate market fluctuations, or investors who want to focus on the short-term bonds part of their portfolio, and they want to like earn a tiny but steady income from the short-term bonds while investing most of their money into the S&P 500 or into the stock market. The second portfolio I'm going to talk about today is the 60/40 portfolio. The 60/40 portfolio is a portfolio that invests in 60% stocks and 40% bonds. This portfolio provides market gains during market rallies and a fixed income reliability from the bond part of the portfolio during economic slowdowns or when the stock market isn't doing that well. There are a few attractive features of the 60/40 portfolio. It takes advantage of attractive long-term returns from both the equity or like the stock and the bond markets. During an expanding economy, the equity part increases in value largely. But as the economy goes through cooling periods, the equity part decreases in value. However, that is offset with the bond performance. So it can like even out. This portfolio also decreases the overall volatility since the volatility from the stocks and the bonds tend to sometimes offset each other. And here above is the historical performance of the S&P 500, the 60/40 portfolio, and the bonds. While you see that the returns for the S&P 500 are higher than the 60/40 portfolio, the 60/40 portfolio has a way smaller volatility and loses much less money in the max drawdown compared to stocks and even bonds. There are some limitations to the 60/40 portfolio, though. This portfolio is most suitable when interest rates go down, as the stocks or equities will perform well. When interest rates rise, the equity returns typically fall, and the bond values will fall too. So that puts the entire 60/40 portfolio at a risk for loss. Additionally, whenever inflation is above 3.0, as we talked about in previous lectures, bonds aren't able to hedge against stock market risks, as bonds will have a positive correlation with the stock market. In summary, the 60/40 portfolio is also pretty simple and easy to follow. It has moderate return potential with moderate diversification, and its volatility is lower than Buffett's 90/10 ETF strategy, as the bonds reduce the overall volatility somewhat. But the risk is that it lacks protection when the interest rates rise and the inflation rates stay high. This portfolio is best for conservative investors who can't tolerate a lot of risk, or um, senior people who have retired and who need stability. Okay, and finally, the last portfolio I want to talk about today is the permanent portfolio. So the Harry Brown permanent portfolio is a classic all-weather investment strategy, kind of similar to Ray Dalio's all-weather investment portfolio. I don't know if you guys have heard of it before, but next meeting we will do a case study where we can compare Harry Brown's permanent portfolio with Ray Dalio's all-weather portfolio. This portfolio is designed to perform reasonably well across all economic conditions. It is simple, diversified, and has low volatility. So there are four major economic conditions: prosperity, deflation, inflation, and recession. So the permanent portfolio is divided into four asset classes: stocks, long-term bonds, gold, and cash, or like cash equivalents, with 25% allocation for each. So each of these asset classes is designed to do well in each, like in one economic condition. In a time of prosperity, when the stock market is booming, the economy is all well, uh, then stocks will do very well, of course. In periods of deflation, long-term bonds will do pretty well. In periods of inflation, gold will do very well. And in periods of recession, then cash or like cash equivalents, such as short-term bond, 1 to 3 month bonds, or like putting your money in the bank and getting interest rates, that will do very well in recessions. So these different asset classes will have different returns during different periods. If you look at table 7.1, which is from 1980 to 1999, you can see that stocks have the highest return, with a return of 17.9%. Bonds are second, with a return of 10.7%, cash third with 6.9%, and gold with negative 2.3%. However, if you look at table 7.2, which is a different time period from 2000 to 2009, you can see the returns are very different. Gold has the highest return with 14.9%, then bonds, then cash, and then finally stocks. And in table 7.3, from 1972 to 1979, you can see it's also different. Gold has the highest return, then cash or like cash equivalents, then stocks, and then bonds. So in different periods and different economic conditions, you see the assets perform very differently. And generally, you have one or two assets that perform the best depending on the period of time. So Minya asked, wasn't there a recession in 2009? Yeah, that's exactly it. I'm showing you like different types of economic conditions so you guys can like know how the assets or how the portfolio performs in different economic conditions. For example, in 2000 to 2009, there was a big recession, so that's why uh you see like stocks performing not very well, and but you see like bonds and gold performing reasonably well. So, as I was saying, here is a great chart for the returns of each asset class under different economic conditions. So, in prosperity, you see that stocks obviously have strong gains. Long-term bonds have moderate or stable gains. Gold is weak, and cash is stable. So, the ranking of the returns from greatest to least is stocks first, then bonds or cash, and then gold. During inflation, though, stocks are generally pretty weak, though some sectors thrive. Because and when there's inflation, sometimes companies will have less profits, and long-term bonds will have losses. Gold will have strong gains, and cash will remain stable. So we have gold, cash, stocks slash bonds. Um, when the economy is in a stagflation, so this means that the inflation is really high and the economy is in a state of recession. Stocks are pretty weak. Long-term bonds have losses. Gold have some gains and cash is stable. So the ranking of the returns is like gold or cash at the top and then stocks or bonds. In times of deflation, we have stocks have losses, long-term bonds have strong gains, gold is pretty weak, and cash is stable. So the bonds, cash, stocks slash gold. And finally, in periods of recession, stocks generally have stocks of course have like losses. Um, long-term bonds have strong gains. Gold is pretty weak and cash is stable. So we have bonds or cash at the top, gold, and then stocks. So now let's look at some historical examples. For example, during the 1970s stagflation, gold surged about 1,500%, or or about 15 times in that decade, countering the equity slash bond declines. And we can see that reflects the inputs from the chart I showed you guys. In stagflation, stocks and bonds do poorly. Gold have nice gains, and cash is just stable. In 2008, here this is another example. In 2008, there was a recession, so long-term bonds rose about 30%, offsetting the stock crashes. So this also makes sense if we compare the actual historical example to the chart. So we can see that in different economic conditions, our portfolio still performs reasonably well, and we still have considerable profits from different assets. Like some assets might not perform that well, but some assets will perform pretty well. And here we can see this is a plot of the Harry Brown's permanent portfolio in bold with stocks, cash, bonds, and gold. You can see it's a really nice curve actually. It has consistent, stable returns relative if you compare it to stocks. For example, in this period of time, stocks experienced a major increase, then crash, then bull market, crash, bull market, and it ended up relatively the same. However, if you had invested in the permanent portfolio, you would have had much higher returns. And here in this table, Um, this is the multi-year real returns for the permanent portfolio compared to the 60/40 portfolio from 1972 to 2011. And in each year, we have the returns for 3 years starting from that year, 5 years, and 10 years for both the permanent portfolio and the 60/40 portfolio. You can see the permanent portfolio pretty much has all positive returns. The only time in all of these years that it had a negative return was here, and that was a negative 0.4%. So these are all non-negative returns, and they might not be very high, like they're mainly in the single digits. However, they basically are never negative. If you compare that to the 60/40 portfolio, on the other hand, you see it's very different. And by the way, you see that there's a lot of like negatives here and like big negative losses. And while you see that 60/40 portfolio does have some juicy profits here there, like it has a profit of 11.9%, 12.9%, 10.5, 17.2. It also has huge losses too, like negative 10.3%, negative 8.3. So it's a lot more volatile. So, do you guys have an idea of who or what people do you think would be most suitable for each portfolio? Like, you can type in the chat or you can blurt it out loud and unmute yourself. Who do you think would be best suited for the permanent portfolio versus who do you think would be the most suited for the 60/40 portfolio?
I think for the permanent one, maybe people who are more busy and they can't like day check because permanent ones are more like stable and less volatility.
Oh yeah, that's an idea. Like maybe some people who are busy, they won't check it out much and they know it's pretty stable, so they won't have to like worry like, oh no, my portfolio is crashing. However, I think that would also apply to the 60/40 portfolio too, because technically for both portfolios, you wouldn't need to like maintain them because you would just like let them like rest there, like maybe rebalance them every year. But I feel like maybe if you were pretty busy and you couldn't tolerate a lot of losses, then maybe you would find the permanent portfolio more attractive because you could like go to sleep knowing that, oh, maybe this year I had a return of 5% so far. Yeah, that's an interesting idea. Okay, Om said old people and busy people for the permanent and day traders and young people for the 60/40. Yeah, I agree with the old people and busy people and the young people for the 60/40. I agree with you. However, I think both of these portfolios would probably be better for probably be good for someone who like was more of a long-term investor, because for the purpose for both of these portfolios is to in and to like invest in maybe some ETFs or bonds, and then just let it sit there for an entire year and not really like care about it. But I believe that like sometimes, of course, you could also make some adjustments to the 60/40 portfolio. Okay, Rob said 60/40 for someone who wants risks and also long-term investors. Yeah. Oh, these are all great answers. They're all really interesting. I think for in my opinion, for the permanent portfolio, I feel there are various people who would be most suitable for this portfolio. I think the elderly, like people who have retired, I think they would favor the permanent portfolio because it's very stable. And people who can't really tolerate risks, I think would also be great for the permanent portfolio versus the 60/40 portfolio. Additionally, I feel like people who might need money in the near future would want the permanent portfolio most. For example, maybe like a parent who has to send their kids to college soon. They can't like afford to lose like 10.3% of their money if they're about to send their children to college in a few years and they need that money. So they may want something more stable. For the 60/40 portfolio, I think younger investors who have a lot of time and investors who like can go to sleep knowing that they lost some money, like maybe they lost 8% in their portfolio, but like they won't be too anxious or they won't be like too sad. So I guess investors who are pretty risk or more risk tolerant than compared to like the permanent portfolio. And yeah. Okay, so here is a graph of the Harry Brown permanent portfolio, the aggregate bond ETF, and the Vanguard 500 index investor. You can see the permanent portfolio has a smaller CAGR or compound annual growth rate than the S&P 500 index. However, it has a much smaller standard deviation, showing it's less volatile, and its worst year is has less losses than the S&P 500 index's worst year, or like max drawdowns. Actually, an interesting thing is that if you had invested in the Harry Brown permanent portfolio from the beginning of 2025, you would actually have had 2.45% return year to date. Compared to the Vanguard 500 index investor, which would have had a loss of negative 13.46%, because we know the stock market recently has been very bad. So this shows that the permanent portfolio can work well in all sorts of scenarios. Right. You can also take a lot of variance on this portfolio too. The classic portfolio was 25% gold, 25% in like stocks, 25% bonds, and 25% cash equivalents. But you can feel free to um change this up or like make some more um positions. For example, instead of having like 25% in a single market index, you could have 9% in US large cap stocks, 3% in US small cap stocks, 3% in international stocks, 5% in US real estate stocks, and 5% in US and foreign natural resources stocks. Or you could have just like picked individual stocks. And instead of having 25% in gold, a single gold ETF, you could have 20% in gold ETFs and 5% in silver ETFs or like other metal ETFs. For cash, instead of just having cash lying around there, you could have US Treasury bills and notes. And for bonds, you could have like various US Treasury long-term bonds or bond ETFs. So you can make your own changes and customizations to this portfolio based on your own investment directions and what you believe will work. So it's pretty much up to you. Okay, so I see we are it's 6:07 right now, so I don't think we will have a lot of time for the open discussion. So we can leave that to next meeting then. So that's the end of today's investment lectures. Um, I hope you all found this lecture very informational. Thank you all for coming. And yeah, see you next month.